Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. In last few days, there were a couple of events like trade deal, RBI monetary policy, and union budget. All of that have put some kind of guidance or key points which is going to impact dollar rupee pair. In today's presentation, we are going to understand where is rupee heading and what is the ideal strategy for exporters and importers. First of all, let me start with trade deal. If you see the chart, it is very clearly visible that India is in a better advantage as compared to other countries like China, Indonesia, Vietnam, and Bangladesh. Now let us understand how it is going to impact FII's flow and our trade deficit or trade surplus with US. Now if you see the table has been divided into two parts. On the left hand side, the table is indicating what was FII's activity prior to tariff imposition by Donald Trump. It is showing that FIIs were positively invested in Indian equities market. As soon as the tariff was imposed, we have seen that FIIs were selling aggressively to the tune of $6.92 billion. Now we are assuming that as the trade deal has been signed, FIIs can return back to Indian equity and debt market. Let's understand what is the impact it is going to have on our trade numbers with US. If we see the table, it is clearly visible that India is having a trade surplus with US approximately close to 40 to 50 billion dollars per year in last couple of years. Now with the new trade deal signed, there can be two possible scenarios. Under the trade deal, we have agreed to import goods worth $500 billion from US, which is approximately 100 billion per year. Now let us understand how it is going to impact. First scenario can be either we import more from USA, as a result our trade deficit will increase, or we can substitute our imports from other country to US. It will have a neutral impact on the trade deficit number. That only time will tell whether we are going for the first case or second case. We have to be very watchful for this data in coming months. Now let us see what data points we have got from union budget and RBI monetary policy. If you see the chart, it is clearly visible that the call money rate is trading above the repo rate. Whenever a call money rate is trading above the repo rate on a constant basis of time, it indicates that there is a liquidity crunch in the banking system. Another indicator which will give us a double kind of a confirmation that there is a liquidity crunch in the banking system. The another data is spread between 3-month certificate of deposit and RBI repo rate. If we see that, that is also at the highest level since 2015-16 kind of a level. That is also indicating liquidity crunch in the system. Now let us understand if liquidity deficit is there, how it is going to impact dollar rupee pair. Because of trade deal, if FIIs are coming into Indian equity and debt market, then what RBI might do? RBI might observe dollar. If RBI is buying dollars, it is giving liquidity into the system. So the natural tendency can be to buy dollars if inflows are coming. Now let us a second reason why RBI will continue to buy dollars is because of RBI short position. Let me give you a detailed perspective about that. As on date, our net short position is $66 billion. Our reserves is close to $723 billion. Out of that, foreign currency asset is close to $562 billion. Out of which we generally assume that 80% of foreign currency asset is in US dollar. So basically we can say that our FX reserve is close to $450 billion. If I adjust my short position and my current foreign currency assets in dollar, our actual net reserves will be close to $384 billion. To give you a better perspective, let us go back to history. In 2021, our actual net FX reserves, after adjusting all short position or long position in RBI's balance sheet, it was close to $462 billion. Today, it is at $384 billion. That is also confirming or is giving a signal that if the flows comes into the Indian equity and debt market, RBI might go and buy dollars. Let's discuss outlook on rupee. So FIIs can come back to Indian equity market and debt market after trade deal, which can give some kind of a breather for rupee. But we do have a challenge. The challenge is liquidity deficit in the Indian banking system and RBI net short position close to $66 billion, because of which we are assuming that if the flows are coming, RBI will come and observe the flows. In this kind of a scenario, 90 to 90-20 is going to act as a very strong support for rupee, and we are expecting that gradually rupee will move towards 91 to 91-20 kind of levels in coming days. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of them have taken costing near 90.20 kind of levels. We will suggest them that they can cover 60% of their exposure near 90.90 kind of levels, and for remaining they can keep a stop loss of 90-30 or costing whichever is higher and aim for 91.20 kind of levels. Now let us discuss strategy for thick margin exporters like textile exporters or engineering exporters. Near 92 kind of a level, we suggested thick margin exporters to participate and increase their hedge ratio. When rupee came to 90.20 kind of level or currently trading near 90.50 kind of levels, we are suggesting thick margin exporters that they should either utilize their existing forward or cancel some forwards which have been booked at higher level to encash the profit. As of now, we'll suggest you to wait for higher levels of 91.20 to again start booking your forwards. Now let us discuss strategy for importers. Last week when rupee appreciated from 92 to 90.20 kind of a levels, we have suggested importers that they can increase their hedge ratio. Going forward, we will suggest them between 90-30 to 90-50 kind of a level, they should go and buy imports for next 45 to 50 days. With this, I will end my today's presentation. Jai Hind. Namaskar. फिर मिलेंगे next week. Thank you.